All right, well, strap in. We got another doozy of a market outlook here tonight. Just a little bit longer. Again, not as long as Wednesday nights, but there's a lot going on in the markets. There's a lot going on in the charts. And, Brandon's been out, as he tweeted out. So he didn't do his mark. So you're kind of getting two market outlooks in one today to finish up what has been a pretty tremendous week. There's a lot of interesting signals. I'm going to break down everything that I'm seeing on the charts. I'm going to tell you what I'm expecting. I'm going to tell you why I think will happen, what will happen, and where we can go down to, and where support is, and all of that. Well, I'll tell you what I expect we'll do here in the very short term, and what signals are pointing in that direction. We're going to break down some interesting patterns from an intermarket relationship and sector standpoint, as well as our trade idea in a very popular stock, one of the big ones, that's kind of showing a new bearish pattern itself. A little different than what the broader market is. We'll talk about how to trade it. So let's go ahead and get started. Today is Friday, September the 23rd, 2022. This is the market outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon right here in the bottom right corner of your screen. Hit the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free with that link up there in the top right corner of your screen. Follow me on Twitter for more content between the videos from day to day. There's my handle, and join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these things over here on the right, including all of our classes over here. Come down to the bottom, click that heart, it opens up this tab. Click the like button. Same thing here, click the thumbs up icon, it opens up that tab. Hit that like button. Again, the more you click on those things, it really helps us, because it helps us get our content out to more of our followers on those social media platforms. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see, despite the little rally we had at the end of the day today, a little bit of a long lower shadow, we did finish with a cluster. So 3 days in a row, not only the intermediate line below the 10th percentile, but a cluster to go with it. So again, that's a bullish pattern typically in and of itself. Now you add on that we got the red dot down here. Now, what does that red dot mean? That means that we are in the below the 10th percentile for the past year, in this case for the past year, of how far below the 30-day moving average we are. So for this past 52 weeks, we're pretty darn low compared to that 30-day. Again, those two dots, when put together, tend to be a pretty bullish pattern. Again, the last one we got was right there, where we had the green dot and a red dot. And you can see the rally we had coming out of there, right? And over here you can see we had 3 in a row, and you can see the rally, that kind of set the low point there. We had a rally going forward. So that's a good sign in the short term, some bullishness, even if, again, we are strongly bearish. Again, it's rare for the intermediate line to get below the 10th percentile. When it does, it generally comes right back out. The fact that we've now been down below the 10th percentile here for how many days? Pretty much every day this week. Every day this week, we've been, 5 days now, we've been below the 10th percentile. Again, the last time you could say that, that we've been below the 10th percentile here on the intermediate line for this extended period of time is when was 2008. Here, if I come all the way over here, 2008. This was the last time that we were below the 10th percentile for as long as we are right now. And over there, we were below it for, how many days in a row? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 days before it jumped back above the 10th percentile. So, and remember, that's the move there that ended up being the move to and through the 200-week moving average that I personally believe that we're on right now. So we're at 5, and again, it generally is only 2 or maybe 3. Most of the time, just 1 when you're below the 10th percentile. So the fact that it's been every single day this week is pretty bearish. Of course, all the major indexes are showing the same pattern. On a weekly chart, because remember we're in a weekly chart here, you can see, I told you how bearish that bear tag was, and I keep reminding you every Friday, how bearish that bear tag was. And I mean, it either leads to a really strong bull market or it starts real bear markets. And I'm talking real bear markets, not just little corrections that everybody else calls bear markets, but real bear markets where we drop below the 200-week moving average significantly and stay down there for an extended period of time. Like, we're still 3% above the 200-week moving average on the S&P. So that's why I say we haven't really even started the real bear market yet. Corrections will get to the 200-week moving average and bounce. So technically, I mean, we're still getting to the 200-week moving average, and technically we could still bounce there for all we know. We are 10% below the 30-week moving average, right? That's a significant amount, easily below the 2.5% mark. We did fail to get above the 2.5% mark when we got that bear tag, a sign that we weren't as bullish as maybe we thought we were at the time. We also did not get above the market sentiment line and rolled over, and you can see we have divergences setting up on the near-term line. The near-term line got pretty low. The intermediate line, remember, got below 10. The near-term line almost got below 10. It got to the 11th percentile. Luckily, with this late little rally, we avoided being below the 10th percentile on the near-term line. And as we know, we got one more week left, and then we'll be hitting the monthly candle. And of course, the monthly, like getting the bull tag, is a bad sign. Is either a really good sign or the beginning of a bear market. And so the fact that on this one, we held and we bounced and things were looking pretty good going into August, the end of July here, and this would be the August and beginning of August. But then August and September and closing below these two candles, getting this bull tag suggests, and now being easily more than 2.5% below the 30-month moving average, suggests that this is a bull tag on the monthly chart. And again, we still got a week left. Seasonally, the worst week of the year, next year, next week, when you're looking at seasonality patterns. So I saw one of the CNBC guys, the Brian guy, talked about maybe we pulled that forward right into this week. But it is seasonally the worst time of the year next year, or next week, excuse me, when you're looking at it on a week-to-week basis. So, barring, a big breakdown or a big rally here, we're probably going to close below those, and that's pretty bearish when it comes to, whether or not we're going to actually go into a bear market with that bull tag. We broke these lines, so if I could zoom back out or into the daily chart, I told you how important these lines are, the 23 and 38, because they're based off of long-term low points. The red line's based off the 2009 low point. The black line's based off the COVID low point. So we broke below both those on Wednesday. The idea is we might come back up. No, we stayed down, and pretty significantly down below both those. We've already had a fake out once. I think we're going to get this kind of move here going into next week. I don't think we're going to get that kind of move where we get back above them. If we do, it'll be very temporary. I don't think we're getting back above these two lines again, not for a while. I think this was the fake out, and when you retest an area where you've had a fake out before, it tends to hold the next time. We're very oversold in the short term, and we're set up for a bounce going into next week. Again, probably going to be very similar to this, but I think it'll be just that, right? I think over here that we'll probably get back to these resistance levels, hold for resistance, and roll over. Let's take a look at the weekly chart on this chart, and you can see PPO is falling. You got a very negative. We got a really, really bearish close here. As of right now, the next week's open is going to be at 38.83, and we're trading at 36.93, which is way down here. So more than likely, you're going to get a lower close. Remember, getting the higher close is when you start to worry. So if we get a high, we had a big down week this week, very similar there in June. This is the midweek June where we hit those lows. But then we had a higher close the next week and we were okay. So let's see if we end up getting a higher close next week this time or not. One interesting thing to look at here is the hull. So we are now almost 5.5% below the 200-day hull. Like, that's a significant level. You don't get that far below during bull markets. So we're back to being, the 200-day hull is just turning back down again. Again, for comparison to the last real bear market that we had, back in 2008 to kind of give you a sense of what happened there. We turned green, and then by June we were back to being below again by about, let's see here, by about 2% back then. But by the time we got to about 5% below here by the end of June, you know, we had like the correction that the move to and through. This is the move to and through the 200-week moving average. Like we were back down, and we never did get green again on the 200-day hull until March of 09, until we got significant. Even over here, you were above it pretty decently, but we couldn't sustain it there in January, and we made one last leg lower and continued. So this is the kind, I think this is the kind of pattern right here, right where my cursor is. This is about where we're at right now. If you're using that analog, this is about where we're at right now. I don't think we're as oversold. When you go back to the end of June 2008 on the market forecast chart, so let's go 2008, and then I come here to 2008. So here's that June time, the end of June, right here, the end of June. So we did get the intermediate line below the 10th percentile, and we got a couple clusters. So I guess we were pretty oversold. We were 6%. Below, whereas right now, let's see, yeah, about 6% below. Remember, right now we're, you know, in about 8% below right now that we're at? Yeah, 8% below. So a little bit more there. When you look at, like, let's go back to, let's go to do this. Let's do 8 or 6, 30 of, whoops, 6, 30 of 2008. Let's go to 7/1 of 2007. So we'll go to the market forecast going into that. See, we weren't in the 10th. We weren't quite in the 10th percentile there. We were in the 23rd percentile. So we didn't get the red dot to go along with it. But I mean, the near-term line was down below 50 for an extended period of time. Market sentiment line was just coming back down below 60. Kind of like about where we're at right now in the market sentiment. So it's pretty similar. We had it was coming off an expiration. This is June expiration. This was a full week after June expiration. We're just coming off a September expiration. So a lot of similarities right now between now and June, late June of 2008, considering how oversold we are now and how oversold we were then. And just to kind of give you an idea of what happened there, you know, going forward, you know, again, considering how oversold we were, right, at the time, this is what happened in a continuation. So here's July. So we just continued lower. The intermediate, I mean, we did get the near-term line to kind of come up a little bit, but the intermediate line stayed down below 10 for quite a while before we finally made a run here at right into July expiration. So this would be our October expiration. So again, from a seasonality standpoint, here we are right here, that I mean, we would still be bearish going into a week before October expiration. You would expect that we would still be bearish. So it wouldn't be surprising. We have an analog, we have seasonality. It wouldn't be surprising, but we also have a very oversold technical pattern here in a very short time frame that suggests that we could bounce up at any time, right? At any time here. Oops. Let's get that chart back up. So let's take a look now at the, we looked at the weekly chart. Let's take a look at the 3 green arrows. Obviously, we still have 3 red arrows. We're not going to get 3 green arrows anytime soon. When you break those lines up, you can see that the 30-day now is crossing over the 50, below the 50. So that's pretty bearish, right? The last time we did that was over here. And you tend to get a rally when you get the bearish crossover like we did here, like right we did here. You got a rally generally right after, and like we did right here. You know, you got a rally right after, but not a trend changing rally. We stayed bearish. So again, that's the kind of rally I think we can get, right? Where we just get back up. In this case, we got to the 30, a little bit above. Over here, we didn't even get above the 30. We just got above the 17. I don't think we would get above the 17 this time. There's too big of a gap between the 17 and the 30. They're much bigger than what we saw over here and over here. The gap's just so big right now and getting bigger. I think we get up back to these black and red lines, back up to the 17-day, you know, and then make that next leg lower, like we saw previously. Excuse me, actually would be, yeah, this leg lower and then this leg lower, like we saw previously when the 30-day crossed below the 50-day. Because again, that's a bearish crossover. It just, to get it, you have to be pretty bearish in the short term to get it. So that usually leads to a short-term bounce to consolidate a little bit of it before you continue in that direction. Already being below the 200-day moving average, and as I said before, we're not even to the 200-week moving average yet. We're still about 3% above it. That's where bear markets start. So bear markets start when you get below it, and they start with a move to and through it. So I think we're going to get through it here on this current move, potentially down into this area. Through, see, SPX would be down into this 32, 3250, 3200 area, and then stop and make a run back up towards 3500, kind of retesting it as that 200-day rolls over, and then we you know, continue on with the declines. That will most likely be through the end of the year, right? Again, if you want to use the same analog, I mean, this is a common pattern for bear markets. You know, that lasted this little run here from early July to September. You know, it's about 2 months, 2.5 months that we retest. After breaking down, you're retested back up to the 17-week and then rolled over. So I see something like that happening again as we get through October. Then we retest into a seasonally bullish time of year at the end of the year, and then we roll back over in the beginning of the year of next year, which is, again, seasonally is a weaker time. So that's my expectations for the markets here going forward, based off, again, not my opinions, just based off these technicals and what we've seen happen in the past. They're very similar to what's happening right now. The RSI broke below 30. That's pretty bearish in the short term. We haven't seen that in a while. Kind of nullifies this one. You know, remember how I told you when you break out of these ranges, which, you know, now we can just, because we're, you know, still in the bearish range. When you break out of these ranges, when you go from a bearish range to the bullish range, you typically, like here, you went from bullish to bearish, you have to do it with a breakdown of the RSI, and either above 70 or below 30. So that looked like we were breaking out to the bullish range. Obviously, it's not the case, but it looked like we were, and so this kind of nullifies that. So, and then easily below minus 150. I mean, these are bearish levels. The DMI, the negative indicator, got above 40. Again, very oversold in the short term. We saw that over here. It took a few more days, but it rallied. We saw that over here as well. We got this big piercing line as a result. And then, of course, the initial move in January got above 50. The positive indicator is well below 20, so your ADX is rising. It's very lagging, so it, you know, it can take off, right? I mean, you know, on some of these other levels, it got up to 30 here, it got up to 35 here, and so we're just not even above 25 yet. But at least we have the light pink shading going. If you look at the weekly version of this, you know, we tried to reverse course, right? But it bounced, and we're back below 20. We're back above 30 now. This week, back above 30 on the DMI. The ADX is back to turning higher, so we're back to being bearish again on the weekly DMI. The trend strength indicators are strongly bearish. Like, we are well below a green cloud. We got the pink crossover on the cloud plotted 26 days forward. I mean, we are bearish. Below -5, above 80. So we have a mature. We have a mature rally going on. A mature rally we have going on here to the downside. So again, same thing we had over here. Same thing we had over here. So when you first get it, when you first get to these mature levels, you tend to get a bounce. You first get to these mature levels over here, you tend to get a bounce. So we're probably going to get a bounce here since we just barely got to these mature levels. But it won't be enough of a bounce to break it, right? To get us back to zero on both these lines. If you take a look at the, the Arun indicator, obviously, I talked to you before about, staying at 100 here. It opens up a new 6-day window. So like before the green line can get to 100. So we're nowhere near a bullish reversal on this pattern anytime soon. I also tweeted about this earlier today. The McClellan oscillator dropped below minus 100 on the same day that the summation index dropped below minus 500. That's a pretty bearish combination. Short term with the oscillator and long term with the summation. Getting below minus 500 is bearish, right? That's when you start bearish trends. Getting below minus 500, getting below minus 500, getting below minus 500. That's when you tend to start these. Like again, go back out to 2008. I don't think this actually goes. Yeah, it does. We do have the data for 2008. So there's, again, there's your rally. It failed to get above positive 500. Ours actually did, but now getting back below minus 500 signifies that we are, and you can see it peaked without getting above zero that time, and that's where we're at right now. We're back below minus 500. We are back to some pretty bearish breadth, and that is trending breadth. You're back in the, we got below the lower, you're already below the lower Keltner channel. You can see the green dots, the bands are outside the Keltner channels. We've been trading pretty much most of this week below the lower Keltner channel, but we're also below the lower band. Kind of again break, when you're trending, when you start a trend one way or the other, it starts with that. Again, very oversold in the short term, but a long-term bearish pattern. So it suggests that we're starting a bearish trend, even if we are very oversold in the short term. We've had multiple days this week of 4 days in a row now, and 6 out of 7, with 5 of those 6 down days being more than 1%. You notice not one of them down more than 2 or 3% on SPY. So it kind of goes to show why the VIX isn't really taking off. Like the VIX jumped up above 30, ended up finishing down below 30, incidentally. And it also finished back below 100. The VVIX took off and stayed above 100. And so again, that's a breakout signal too. That signals the beginning of a bearish move if we get back above it. And stay above it, especially at the VIX. I mean, it will start to signal bigger moves on the VIX to the upside. And that's probably what's going to finally get us to the 115, 120% levels on VIX relative to VIX 3M. Remember, VIX 3M is just so stubbornly high. It's already above 30. So the VIX 3M, when it's above 30, the VVIX is generally well above 100. So it seems like the VVIX and the VIX are starting to catch up to where they should be based on where the VIX 3M currently. Like when the VIX 3M's at 30, as you can see back in the past, the VIX tends to be pretty high. Like, you can just see my cursor, follow it along, but especially even before, like when you look at 2018, so the last real normal correction that we had, when the VIX 3M finally got, in this case, just a 28. The VIX 3M got to 28. The worst case scenario during a pretty deep correction, got to the 200-week moving average. And at the time, the VIX was 125% above. Like, go back out to 2015 and 16, that correction, the VIX 3M got up to about 28. At the worst case scenario, it got up to 31 here. And on that day, it got to 31. The ratio down here at the bottom was at 138%, 131%. Go out to 2011 right here. So again, the VIX 3M got to 43, so that's the worst it did. But over here, it got to 38. At the day that it got to 38, and really it got to 30 here on August the 5th, well, on that day, we were well above 100%. We were at 110%, and eventually got to 126% on the ratio. We're still not even getting above 100% with the VIX 3M at 30. So again, the VIX and the VVIX are at really, really, really low levels for where VIX 3M is currently. And I think we have some catching up to do. I think that's another sign that this isn't a typical correction, that this is a correction that will eventually morph into a bear market once we get to and through the 200-week moving average, right? The 200-week moving average there. All right, when you take a look at what's driving the price action, and a lot of it has to do with yields, especially in the short term, yields and the dollar, right? And this is the different asset classes over the past 3 days. So post FOMC, the dollar just, I mean, that's a huge move for the dollar in 3 days. Really, really tremendous move. I mean, in fact, one of your bigger, if you go to a rate of change here, if I go to the rate of change chart and I go to just a 3-day move for UUP, you can see it's the, outside of, again, COVID, that's the biggest 3-day rally we've had in the past 5 years. If you were to go out a little bit further and go 2.71, right, again, 3-day rally. We had right here, you had a big 3-day rally in 2016 June, and we continued to be bullish going into the end of the year. You can see a big 3-day rally coming off of a pretty deep low in October of 2011, and then of course in the bear market there. But needless to say, that's a tremendous move to the upside in just 3 days, and it's kind of a little bit of a blow off top. This, unlike all the others, we've already been so bullish going into today that you have the makings of a blow off top here, especially when you look at like the volume associated with the ETF at least. I mean, it's a above average volume, big gap. It has the makings of an exhaustion type gap on the dollar index. Interestingly enough, a weakening dollar would actually probably serve to boost commodity prices up. It's a pretty big drop in commodity prices. In fact, if you look, commodity prices broke the 50-week moving average. That's generally the beginning of a correction. If you count this as a pullback and a failed pullback bounce here, that's generally the beginning of a correction. And generally, when commodities start their corrections, that's when the bear markets start, right? Because commodities are generally bullish during the correction phase of a bear market, because it's the your inflation, and we saw it in 2008, we see it here too. But now that it's finally correcting, now it's finally below that. But you can see again with the gap that this could be very short-lived. Like in the short term, we can fill in that gap and come back up towards resistance before eventually rolling back over again. And I can definitely see that an exhaustion gap in the dollar kind of moving that up to the upside. But that's the short term. But in the long term, the breakdown is really bearish from a asset class standpoint. The fact that we're dropping. I mean, look how much it's down 14% in the last 3 months. Gold's down. The dollar's up 9% in the last 3 months. Bond yields are up because bonds are down. Bonds are down right there with equities. In fact, bonds are more bearish in the last 3 months than equities have been. They've just turned negative. So when you look at the rate of change again for SPX over the last 3 months, we are back to 5% below. So 3-month rate of change, 5% below. When you get to those levels, that you can get little tiny 3-month losses, here. But once you get to about that 5% mark, if I go minus 5%, you tend to get more. You tend to get more than just a little pullbacks, right? Little corrections. Even over here, there's little pullbacks. You tend to get corrections, right? You tend to get corrections. You tend to get a correction in this case, and going back even further. 2015, 16, you tend to get a correction, but not during any of these other times. None of these other times. You got a little bit of 1 and 14, we immediately came back up. 2011, you get a correction when you drop below 5%. 2010, you get a correction when you drop below 5%. 2008, you get the correction, failed correction bounce, and then you get the move to and through the 200-week moving average here that got you below 5%. And so I think, again, we're below 5%. We're at minus 5.58 over the course of 3 months. That's correction levels, right? Those are correction levels. In this case, a second correction, a back-to-back correction usually leads, again, to bear markets, especially with the market sentiment failing to get above 60, right? We didn't get above 60. We failed and rolled over, and you expect that we'll continue moving to the downside there. So it's not, again, this is a really significant thing that, that we're breaking the 200-day moving average, that you're breaking into this volume gap area, but there's such a gap here. I mean, just to kind of give you an idea, there's such a gap here on the, let me go all time, between the 50 and 200-day moving averages. If I go to crude oil, just so I can see what it was like back in 2008, like those are pretty significant gaps. These other two produced kind of some correct. I mean, this was a bear market over here in 2006, 2007. You kind of had that housing bubble burst. You just had a correction there, but then once you got that second peak, then it was a bear market, right? Well, here we are again. I mean, look how high we are. We're in the 99th percentile of where the gap between the 50 and the 200 week moving averages are, and they're simple, 200 week moving averages. So a drop into, I mean, we're already correcting on crude oil because we're below the 50 and we're working down towards the 200. But the PPO, it's just barely crossing over its 9 weeks. So like we are just starting, as you can see with DBC, to correct. And when it corrects, then that means, I know that the narrative is, oh, can we please have falling commodity prices because inflation will come down, Fed will stop raising rates, and everybody will be fine, and new highs by the end of the year. That's not how it works, right? There's two ways to lower inflation, especially from a 9% year-over-year rate to a 2% year-over-year rate, which is what they want. There's two ways to do it. You either increase supply by a ton, or you destroy demand. Those are the only two ways to bring an inflation level, not from 3% to 2, to bring it from 9% to 2. There's only those two ways. You either increase supply by a ton, or you destroy demand. And so demand destruction is synonymous with recession and bear market. You can't have demand destruction and a growing economy and a bullish stock market. It's demand destruction to that point of bringing an inflation rate from 9 to 2. Remember, it's not just the headline. The median CPI, which takes out the biggest changes on both sides, the biggest gains and the biggest losses, the median CPI is still at 9%. Like, it actually rose in August. So taking out the really volatile parts, whatever they are, right? Whatever the volatile, just keeping the middle, right? That's not so volatile. It's still at 9% year over year. So you either increase supply by a ton, which obviously we're not doing, or we kill demand. And that's what we are doing. And again, that generally is unbelievably bearish for commodity prices. And one proxy for that is copper, and copper has already corrected. Right, so copper is already corrected and is now, in bear market territory. And the last bear market it had, was during this QE period, and then eventually this global slowdown. Like copper, and you can see what happened in 08. Copper's already had its bear market, and it's hard for an economy to be strongly bullish when copper is falling, because this is a reflection of what the economy is doing. If we fall back down towards COVID lows, which is where I think ultimately a bear market would lead us. If you follow me on Twitter, I won't spend the time on this. If you follow me on Twitter, I tweeted out here, and let me pull it up. Here we go. I tweeted out earlier today, here it is, about the linear regression trend line. So from a bear market standpoint, how far down can we go? Right, well, this is where we're at, so we're still well above the 20-year linear regression lines. We're still well above it. I mean, that's actually pretty bullish to be that far above it. So we were just insane above it, and I'll show you why here in a minute. But this is the 2008 bear market. We got to 2 standard deviations below. Here's the 2002 bear market. We got 2 standard deviations below. Here's the 1974 bear market. We got 2 standard deviations below. So we are more than likely going to get to 2 standard deviations below, right? And if you don't think we can, and this is what I tweeted out earlier too today, if you don't think we can get that far down, because that's just a long ways down, just think that we should also then not be able to get 2 standard deviations above. But we did. We got the 2 standard deviations above in March of 2021. Not this year. We got 2 standard deviations above, which, remember, if it's hard to get down to the bottom, it should be just as hard to get up to the top. The odds are the same, right? The odds, it's 5% split in half. So we got up there in March of 2021 and then rallied 20% more. We had a 20% gain from March of 21 to this year's high at the beginning of the year. We rallied 20% after we got to an extremely overbought condition. So if you don't think, if that can happen, getting 2 standard deviations to the downside can happen too, especially considering it's happened already, right? In 08 and 02 and 1974, during the last real secular bear markets that we've had. All right, let's take a look at the sectors here and how they performed. So give me 1 second to pull that up, and we'll take a look at the, well, let's take a look at the 12 grid first. You can see everything, dark pink shading and a red line, all across the board. And real estate, energy, everything, dark pink shading and red line. When we're remember how energy held up for so long? It was dark green shading and a green line for so long. When you're bearish, everything's bearish. Nothing holds up, right? Nothing rotates. Everything's bearish to the down. It's just a matter of degrees at that point. But if you take a look at the comparison here, and again, just looking at what happened here today, last 3 days since the FOMC meeting, interestingly, you can see the biggest losers were in discretionary is one, which you'd assume would be the case. Consumers are getting hammered right now with rising rates and rising inflation, right? So they're getting hammered. But energy, materials, not surprising, the dollar was so bullish. Financials, industrials, those are surprising. It's surprising that during what's been a relatively bearish few days, and really if I go all the way back to the miss on the CPI report, right? So the last 9 days, which we are down more than 10% in the last 9 days. That has also been a signal in the past of a very short, it's very rare to be that oversold 10% in 9-day period. It tends to be pretty bullish in a very short term. So another sign that we could bounce up pretty quickly. But if you look at those last 9 days, look at what's at the bottom down here. Industrials, real estate, materials, energy, in addition to the 3 generals, XLK, XLY, XLC, financials as well. And you can see the safe havens holding up, but not much better, right? So it's been pretty much a full-on across the board selling, which goes to show again that everything, like when you're in a bear market, everything drops, right? When you and eventually you're going to have these 3 things, these 3 sectors, the biggest sectors, and they're going to be the biggest ones to the downside again. XLK is down 28%, XLY is down about 28%, XLC is down 36%. You're going to just expect that they'll continue. Real estate's down 28%. Materials is now down. Energy is falling. Was up 50%. Was up 60 some odd percent at one point in time year to date. It's now down, well off of its highs. Utilities is almost negative year to date after being pretty, nearly 10% to the upside. So, I mean, this is not correction. This is not very indicative of a correction. Corrections correct the declines within months, generally about 8 to 9 months, 6 to 8 months. We are at the 8-month mark now since we peaked, and we're nowhere near getting back to that January high. So this is not indicative of correction. This is a lot more indicative of again, the beginnings of a bear market, a longer term bear market. Even if in the very short term, more than likely we're going to rally. I mean, is it pretty much, if not next week because of the seasonality of it, pretty darn soon, right? Pretty darn soon because of how oversold that we are. If we end up following that 2008 analog, right, where we were just pretty much this bearish, and then we just stayed bearish for like another week or so, We can, because of the seasonality, we can definitely see something like that occurring again here. But don't be surprised if we do bounce in the very short term. Just don't get caught up in it. I know they'll bring Tom Lee back on TV and saying, look, see, I told you we're going to go back up to new highs by the end of the year. If that happens, don't get caught up in that. It's just a bounce up to moving averages, bounce up to resistance, and probably, my opinion, more than likely will be nothing more than that. All right, now let's take a look at our trade idea of the day, and I want to take a look at Tesla. So Tesla, as you can see, is not nearly as bearish. I mean, we're retesting June lows on the S&P. Tesla's not. So, but it is turned. Right, the intermediate line is turned down. Did not get, after getting in bearish territory, barely. Really good bullish intermediate low point there. We followed up with a pretty bearish intermediate high point. Like, they only touch your toe above 80 and turning back down already below market sentiment, almost below bullish territory with a very bearish short-term sentiment. That's a bad sign from a market posture standpoint. If you take a look at the weekly chart here, you got the red arrow, which means we closed below the 10-week exponential moving average. You got a transition candle, which you can see you had one over here too. But look at the difference between the two candles when you look at them on the real candle. Right, that one was a really bullish candle, and this one's a really bearish candle. So pretty bearish pattern from that perspective. You got 3 red arrows on Tesla, so you can see we got 3 red arrows finally today. The stochastics was the last one. So there's, again, this is either one of those, it's either pink for one day or maybe 2 and that's it, or we're bearish, and I think it's the latter in this case. And the reason why I think it's the latter in this case is because we closed below the 8, 17, 30, and 200 yesterday, all in one day. So closing below multiple moving average is significant. And then today, closing below the 50, very significant. As you can see, the point of control is above us. There's no volume below us. So, and the MACD is just turning negative below its moving average and turning below 0. So, there is an opportunity here for Tesla to be bearish here for a while. The DMI is just now turning bearish. The ADX is setting up for what could be a trending move. Same thing with the Bollinger Bands, really low bandwidth. It's starting to rise, getting to lowest quartile. You take a look at the Ichimoku trend strength. There is no trend right now according to this, but you're into the cloud now, easily below the green and the blue lines, about to get a pink crossover here in a couple of days. Probably going to get a pink crossover there. So, I mentioned, we look at the Arun indicator, right, for the bearish move. The red line is below 70 already, or excuse me, the green line's not quite below 70 yet. The red line's not quite below 0 yet. But you can see again how close we are to a 4-week low. We're a lot closer to a 4-week low point than we are to a high point. So in fact, when you look at it on this chart, on the intraday chart here, you can see that we are into the lower half of the chart easily. And like I said, that close to the 4-week low, way off of the 4-week high that we just got a couple days ago. So, and then all the volume, no volume below and all the volume above us. So it's pretty bearish pattern setup, kind of like Marriott. That Marriott trade that we did on Wednesday is already done. So what I decided to do is do something very similar on Tesla. Sell a bear call spread. Again, because the possibility that we could rally, right? We could rally up in the very short term. So I'm going to give myself some flexibility in case we do rally. But the potential of getting out really quickly if we continue to drop, just like Marriott, right? Marriott, in 2 days, we were done. We had 50% of maximum gain. So, we got 8 days here that we might be able to get 50% of maximum gain and take it and use that $1,000 on another trade, right? On a third trade. So it kind of gives you an idea. That's why you take that 50% quickly if you have more than 20 days left, because then you can use that capital instead of getting the other 50 maximum gain. You can get a full maximum gain for the other 20 days somewhere else. All right, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Follow me on Twitter and Facebook and like our tweets there. Join our website at marketscholars.com for free. Have a great rest of your weekend, everybody, and we'll see you all on Monday.